Hi everyone, welcome to another honeystocks.com stock market outlook, and this one is going to be going out on the weekend of 4th of July 2022. Happy 4th of July weekend to all my subscribers from the US. I've no doubt there will be some hangovers amongst many of you at some point. But before I switch over to my screen share and walk you through many of the charts for the broader market and some individual stocks that I think are potentially rebounding and some areas of the market that are certainly quite bearish, there's a few things that I have been asked, lots of messages, lots of emails regarding inflation, yield curve that I've been talking about for the last few weeks. I've got a better chart prepared. You'll know that I don't use the magical hindsight indicators, so hopefully you get some value from my work. But the first thing to say is we are in a bear market. We are technically in a bear market. The S&P 500 has been obliterated. Technology has been obliterated over the last few months, as I'm sure most of us have noticed. But with my work, just to get it out there, as I'm not a day trader, I couldn't think of anything worse. I think if you were to sit and have a beer with me this weekend, you'd find out that I'm more of a technical investor. Yes, I use technical analysis and fundamental analysis, but it's really a longer term approach that I tend to work with. But my work does apply to many styles. I'm told that my work is good for swing trading, for long-term investing, so whatever your time horizon is, let me know in the comments what you think. But I am flexible with long or short positions as well. There's many of the charts that I'm going to be walking through that are bearish and some are looking quite bullish, but there's a lot to get through, so let's dive into some charts and let's see what the market's telling us. Now, before we get into the charts, as always, please pause the video, make sure you are comfortable with that before watching any further. Basically says don't be silly, do your own due diligence and all the good stuff. A little bit of credibility, working my way towards my CMT. Technical analysis is something I'm widely known for in professional circles. A few of my recent calls just last week, calling for an oversold rally in a lot of the beaten up names. Some of those names moved 20-30%. Recent call in the top of energy in the 8th of June. You could go all the way back to where all the carnage started, which I understand will not help many of you watching this just now if you didn't get defensive, but way back in November, highlighting the elevated risk of a failed breakout in the small caps, and to start managing risk very, very closely. Same thing with the S&P 500 back on the 5th of January. And also the valuation reset, and we could go all the way back to the crash of 2020, getting a lot of our clients and members defensive ahead of the big crash. So I do have a decent track record of being correct, which helps in this industry. So if you get some value from this, please do like and subscribe. So I think where I should start off is just touching on the yield curve again. Now, I've touched on this a few times over the last couple of months, and I think this chart shows it really, really well. Just highlighting that we've had minor excursions below zero, which means the curve is inverted, and we know from that data that it's a good predictor of a likely recession. And this is the headline today. I'm recording this just after the market close on the 1st of July, and we are seeing that the Atlanta Fed is showing that US economy is likely in a recession, and we know stocks don't tend to do very well in recessions. That's just common sense. But what's really interesting to me is I look to a few different analysts, and Michael Burry, I'm sure you all know about The Big Short. I'm sure many of you have watched The Big Short. If you haven't, it's an excellent film. But Michael Burry is highlighting that he believes that the S&P 500 is heading for an almighty collapse, even from current levels. And his thesis behind this is, if we look at prior crashes, we have previously dipped below the lows of the previous crash. We can see that in the 68 and 73. We can see that in the dot-com bubble, in the financial crisis. And Michael Burry is highlighting the elevated risk that the same thing could happen again. So although buy the dip has been monumental over the last few years, I get it. I think the environment we're currently in at the moment, it warrants a lot of caution with the market. It really is a week-to-week thing at the moment. I do have some charts that suggest that the market has found good solid support levels, and I will go over that in a second, but we'll need to see how this one plays out. Michael Burry, of course, has a track record of making big calls and being correct and making lots of money on those big calls, so I find it very, very interesting. So I wanted to just build out the chart just to show that yes, we could be in an environment where we can, certainly nibble a little bit, but the bigger picture is there are charts out there that look scary, and this is one of them. Now, this chart got a lot of attention during the week, and I posted it to Twitter. If you don't follow me on Twitter, I do post quite regularly there. You can just get me under Honey Stocks. But what the chart is essentially showing is the credit spreads. Now, when credit spreads start to move, if you don't know what credit spreads are, just have a look on Investopedia. But when the credit spreads start to move, we know that volatility starts to move with it. We can see that there's a pretty distinct correlation. And what my chart is essentially saying is that credit spreads are on the move, and it's likely, or it's logical to me, that the VIX will potentially follow. Now, if that's the case, we know that when volatility spikes, that tends to be an environment where stocks aren't doing too well. Of course, when we just look at the VIX, I know what some of you are saying just now, technical analysis on the VIX is pointless, and I get it, but what I do look at is if the VIX is elevated and it's making a series of higher lows, that's something that I want to pay attention to as well. So we'll need to see how this plays out. We did get a spike in volatility. I think it ended up 7 or 8% the other day. And of course, the market has closed the week on the 1st of July and had a decent day. So we've seen the VIX start to retreat a little bit. Now, the 10-year Treasury note yield is looking like it could potentially roll over. Now, if you have followed my work over the last few months, you'll know that with the 10-year Treasury note yield, I've had a thesis that if the 10-year note rolls over and the dollar index rolls over, then that could be a bullish catalyst for stocks. Now, nothing has really rolled over as such yet. It's of course pulled back a little bit. We've seen the 20-year Treasury bond ETF TLT do exactly the same, because they are of course inverse to each other. That a lot of our clients and members this week have started to buy up TLT with the understanding that it is in a downtrend, but it is one of those areas that, it's traditionally defensive. So if bonds are going to move, then TLT could be appealing to many of you. But I think one of the key charts to watch over the next few weeks is the financials. The financials are back at the scene of the crime from the financial crisis. Is it a massive top, or are we going to rebound spectacularly? Given some of the weightings, of course, with financials, implications, of course, for the likes of the S&P 500. Now, touching on the Dow, this is one of the charts that kind of alluded to at the start of the presentation, that it has got a solid footing there at the scene of the COVID crash. It has rebounded, so the Dow is starting to do pretty well. But of course, we know the environment that we're in, and yes, whilst it's okay to nibble on a lot of the ETFs, I think at the moment, I think for me personally, the ETFs are a lot less stressful, I guess, than a lot of the individual stocks. A lot of our clients are moving in on some of the ETFs from our client chart book, and certainly the Dow has found a little bit of a footing there. The Russell 2000, again, exactly the same. It's back at the scene of the COVID crash levels, and given what we know with the Russell 2000, it's a good gauge of market risk appetite. If the Russell 2000 breaks below the COVID crash levels, then I think all hell will break loose with the market, and that's going to be in an environment that doesn't look too great. But on the positive side, July has started off decent. We will need to see how the market reacts and opens on Tuesday. Of course, it is closed for 4th of July. So that the Russell 2000 chart is very, very interesting to me at the moment. And of course, again, another one of the charts is the triple Q's technology. We can see dating all the way back to 2006 that the 200-week simple moving average, there's nothing fancy about the chart, but what it does tell me is that it is a decent place if you are looking to nibble a little bit. Of course, we had in 2008, we had a bit of a rebound before it collapsed below the 200-week, but that is the only occasion since 2006. Every other time it has held up pretty well. We've got the US versus China performance. Now, if you haven't been looking at China over the last few weeks, I recommend getting out some of the charts. I do have a few charts prepared this weekend, some of the charts that I've already shared with our clients. But we can see that the Shanghai Composite over the last 3 months is now positive, whereas we can see that the likes of the triple Qs, etc., are in massive negative territory. Now, lots of theories behind this. Economic expansion in China seems to be the words of the week, but certainly that's what we call relative strength and relative outperformance. So China is back on the radar and looking very, very interesting to me. But I think I will start off with the individual names aligned with big tech. I have covered these charts many times over the last couple of months, highlighting these levels, and Microsoft is still holding in there. I think you can still remain bullish on Microsoft. I think the problem arises if it starts to break below these lows from last month. But I think you can remain bullish on Microsoft at the moment. I think similarly with Amazon, I put out a social media analysis on YouTube a few weeks ago, highlighting that Amazon might be one of those to consider buying the dip on. I think it moved 15-16% almost immediately, but it is holding on to that $100 level at the moment. It is chopping about sideways, but again, I think you can remain bullish on Amazon provided it's above 100. To the other side, we've got big problems, I think, with Nvidia. Nvidia has broken below today in a meaningful way, below key support levels. I think the semiconductors are breaking down relative to the S&P 500 now, and that's a big problem. So, you know, if you are a long-term investor in Nvidia, I don't think there's any harm in some protective put options, you know, however you want to hedge against any declines. To the other side, I would absolutely love it if it just did an about turn and put in a failed breakdown and ripped higher. But I think Nvidia at the moment, it has now closed below 150, and for me in my world, that's a big problem. Similarly with AMD, I did put out a chart for AMD last week. It looked like it was going to start moving, and then all of a sudden semiconductors just collapsed this week, but it is back to a big level of support. So how the market opens on Tuesday here will determine, I think, where AMD goes. With the likes of Nvidia and AMD, I think they are both exceptional companies, solid fundamentals, etc. But at the moment, semiconductors are not in fashion, and that's a problem. Exxonmobil, again, it's just chopping about. I did touch on this chart a few weeks ago. I think for me, ExxonMobil has to probably decline a little bit more to become appealing, but there is a case to be made that a lot of the commodities and the likes of energy, etc., have maybe topped out. So, when ExxonMobil breaks out above these levels, dating back to 2014 is anybody's guess. So for me, ExxonMobil isn't really terribly appealing at the moment. This week, PayPal put in 52-week lows. Again, that's not a characteristic of a stock you'd probably want to buy. The 50-day simple moving average has been a problem for the stock. We could go all the way back to November. As you all know, I don't use the magical hindsight indicator, but the payment processing companies are under pressure, and they have been since last year. The Bitcoin Lightning Network, I think, is a problem. Obviously, free transactions, etc., using the network. And there's been a lot of disruption, and we'll need to see. Of course, PayPal is still a great company. There's nothing wrong with it. But there's been a valuation reset, and unfortunately PayPal is one of those names. Micron Technology earnings this week looked half decent, but the market has received it negatively. How much of that is down to semiconductors and as an asset, a sector, but certainly solid fundamentals, but the stocks are being taken down at the moment. Similarly with Square Inc., huge PE ratio, negative 12 months earnings growth, and Bitcoin on the balance sheet. Now, the problem I have with stocks like this is in a bear market, and if we can anticipate, a downtrend over the next few months, rallies into overhead resistance gives an opportunity to take a position in the direction of the underlying trend, and block, as we can see, is in a very, very clear downtrend. Similarly with SoFi, I've had a few messages on this one. Somebody said I didn't know what I was doing a few weeks ago, but it's the 50-day simple moving average. Again, nothing fancy about the chart, very, very basic technical analysis. And the 50-day simple moving average is a problem. Again, no earnings, so there's no PE ratio, and of course no earnings growth. So highly speculative name, and it's in a downtrend at the moment. ARK, I do have a target of $50 on it. It's in a massive sideways range at the moment. We know with range bound plays, it's very, very simple. You buy at the bottom and you sell at the top. If it breaks down, you just don't take any chances. You've got your stop loss in place. Again, 52-week lows this week for Nike, on the back of reasonable earnings. I think the wider dynamics of the market is really down to inflation. Is anybody spending money on Jordans at the moment? I'd argue no, but it is looking like it's breaking down a little bit here. It could absolutely do an about turn. Many stocks will do it. I like to just kind of wait a couple of days to see if it does put in that failed breakdown. And of course, if it does a failed breakdown, it could quite easily do something like that. So don't always jump the gun on great companies that are breaking down. Sometimes it's worth just waiting a couple of days to see if it does an about turn. Netflix, I've got a 205 target. Again, I touched on this one a few weeks ago. It's in a massive sideways range at the moment, and I think, of course, I'm not going to break the internet with my views on Netflix, but the direction is going to be determined whether it breaks up or breaks down. Until that, I've got a 205 target, and if it breaks down lower, again, I think it's a valid short. The DBC is a commodity tracker ETF, put in a massive failed breakout. I touched on this one on the 22nd of June for our clients and members. It actually is an open high conviction alert that was sent out, and our clients and members are doing very well on this at the moment. I think commodities are under pressure at the moment, and we'll need to see how things play out. I've got a trailing stop loss, and I think that will determine, of course, how far the position wants to go. Chipotle, big support level in place. I touched on this chart last week. I think very easy to make the case here. I think if we are above that, let's call it 1200 level, I think you can remain bullish. But again, if you are somebody that pays attention to chart patterns, you could potentially interpret that as a head and shoulders pattern. So if it breaks lower, then that's a big problem. But I think you can remain bullish on Chipotle, provided it's above that 1200 level. Now, I touched on China at the beginning of the video, and it's very interesting to me that some of the ETFs aligned with China are starting to put in these base bottoms now. I'm sure there's many of you that when you're buying dips, you know, you think to yourself, oh, it's bottomed here, oh, it's bottomed here, it's bottomed here, and then the downtrend tends to continue lower. Now, I think hindsight tells us this is capitulation. So there's, of course, news attached to this down move. That is what capitulation probably looks like in the S&P 500. So if we get that kind of capitulation, that is often a signal that the market is starting to approach a bit of a bottom. And when it does, you tend to find that we start to build these bases. Now, I would much rather pay a higher price for a stock with the safety of knowing that I can manage risk and have a well-placed stop loss on a base breakout. So I think K-Web, I think, looks very interesting. We're seeing very similar price movement attached with Alibaba. I posted this chart to Twitter a few weeks ago highlighting that Alibaba had reached an overbought condition, which is a characteristic of an uptrend. Of course, we know that it went through a massive bullish phase. It went through a massive bearish phase where the stock did not reach overbought conditions. When we're in a bullish phase, it doesn't reach oversold conditions. So I like to pay attention to these minor details, and Alibaba has reached an overbought condition. So if we start to go into a bullish phase on a base breakout, I think that could be decent news for Alibaba. But like I've already communicated to our clients over the last few weeks, very stressful with China. You just have to be accepting of the news, the volatility, the closing of the economy, all the good stuff that China has been known for over the last few years. There's a Taiwan situation as well, so there is certainly, in my opinion, elevated headline risk. But if we're looking primarily at price, and of course the economic expansion that they're seeing with the lockdowns being removed, etc., I think there's a case to be made that China could be an area to look at. Now, this is one of the charts that I've already built out for one of the smaller names, and IQ. Again, we've got decent PE ratios, we've got positive earnings growth, and above $6, and I think there's massive upside if these names do start to get moving. We just need to look to history with the likes of IQ. Now, we're going back a long time here, but this was one of the names that was put to our clients and members a few years ago on this move here, and the thing just ripped 100% in a few weeks. So certainly, I think IQ above $6 makes a lot of sense. eBay, again is in a downtrend. We sent this one out to our clients on the 24th of May, and it's respecting its downtrend. So we'll see how that one develops. But again, I'm not rewriting any investing books here. Negative earnings growth. These are the types of names that are being taken out to the woodshed at the moment. Home Depot, on the other hand, I think it's, of course, very, very solid company. I've got a 200-week moving average here. I think you can nibble a little bit, provided it's above these levels. Of course, we're going back to the COVID crash, and if we start to break below those levels, that's a problem. That's maybe in an environment where the Dow, the S&P 500 are probably under a bit more pressure. Now, one of the names that doesn't make a whole lot of sense to me, certainly why it's rallied, it's rallied hard off support levels, but going back to what I was saying, I think the rallies in stocks with poor fundamentals, huge PE ratios, etc. I think they're going to give an opportunity to reload and go short. Now, I could be absolutely incorrect. Let me just build in. I think if, of course, we start to break out above those levels, there's, you could make the case that the bottom is in on NVCR, but I don't think the sentiment on overvalued companies with negative earnings growth has changed overnight. So certainly if it breaks below these levels, $50, then I think that's a problem. But I think these are the types of names that you could be looking as opportunities to go lower. Eli Lilly making new 52-week highs. We've got Shopify, big level. I posted this chart to social media today. It's had its recent 10-to-1 stock split. We're trading around that $30 level. I think this is a big level for Shopify. I think if it breaks below these levels, then it continues to get worse. But again, these are the types of names where you could potentially look to nibble a little bit, with the understanding that managing risk is absolutely paramount in the current environment. AYX, again, violent 30% bear market rally. Again, this was high conviction alert that was sent out on this breakdown. I think it moved 15% to the downside, did very well, but then we've had a violent bear market rally. I think with, again, these names, I think they're offering opportunity to go short. Zoom holding on to its 10-week simple moving average, potential failed breakdown, reasonable fundamentals. So I think that could be something to consider for a short-term mean reversion idea. And we've got Trade Desk holding on to a key support level at the moment. Where this goes next week, if this breaks lower, again, with massive valuations and negative earnings growth and really just the sentiment around a lot of the tech names at the moment, I think that's likely a bit of a problem. So certainly something to add to the watch list. Now, perhaps you've just stumbled across my work. If you have, please do like the video, subscribe. I get nothing for this. It's totally put out to social media. So if you've stuck around this long, please do hit the like button. Let me know in the comments, do you think the stock market is going higher or lower? What stocks are on your radar? I will be taking a break from my social media videos for a few weeks. But if you are wondering, what it is I do, you can jump on to our website, honeystocks.com. We provide charting research. We provide premium weekend analysis to all of our clients and members every single Saturday. Provide high conviction investment ideas, trade ideas, whatever you want to call them. We provide a midweek halftime report. Provide access to a wonderful community. You get full access every single day to my chart book, which has all my charts for a lot of the main sector ETFs and stocks, etc. And we also provide access to our technical analysis program, and we are doing a summer 20% discount as well. So feel free to go and check that out. But these are really what our high conviction alerts look like. This was a recent alert that went out for Zillow. It did pretty well. Cloudflare, it was massive. Square Inc, massive. Box, again, another recent one, hit our target down at 20. We've got Antero Resources, was an absolute animal over the last couple of years. But I am very, very unique in what I do. I'm completely transparent with my work. Every single one of our high conviction alerts is logged on our website for complete scrutiny. So you can go and have a look to see if the types of stocks that I like to recommend are the types of stocks that you like to buy or short. Recently there have, of course, been short ideas, but mainly on the whole it's been very long over the last few years. But feel free to go and check that out. But I think my work is probably a good fit for you if you are in positions for weeks to months. You've maybe got that slightly longer time horizon. If you are a minute time frame day trader, please do not come anywhere near my work. It's not going to be a good fit for you. If you're looking to learn technical analysis, I'm told that the program I've built out is very, very good. If you want to be part of a really good community, if you want to stop hunting around social media for lots of ideas and stock twits and all the nonsense that you get there, maybe you just want to have daily access to a professional analyst who can provide chart requests for you, probably a good fit. But I probably can't say it any more than my members do. Again, you can go and have a look at these, pause the video, but Dan has done some incredible numbers over the last few years. Sean, look forward to many years as a member. Nick, member for life. Rocco, guidance made his year, and yeah, I don't really know what to say. It's that's my work. So feel free to go and check out our website, and I hope to welcome you soon. But if you have stuck around till the bitter end, thank you very much, and I hope to welcome you soon. Thanks.